And I think that means we are live. It is Value After Hours. I'm Tobias Carlisle, joined as
Bank
always
run edition.
by Jake Taylor and special guest Tim Travis, who's a specialist in banks value investing. Is that fair, mate?
That's fair, yeah. Value
Financials?
investing, and a lot of the time, especially over the last decade, that's involved financials. So it makes sense.
Yeah, I was gonna ask you about that. Is that it's not because you have any particular affinity for banks. It's just that it's been a cheap financials environment, so it's paid to become an expert in that area.
Yeah, I think that's part of it. I think also just working in the financial services industry, you get a feel for the different revenue streams of different companies like insurers or banks, and so you just stay within your circle of competence. But absolutely, like we've had big positions in energy before, large cap tech, healthcare. We kind of go wherever the value is, and just as more of like kind of a deep value guy, kind of like you are, Toby. As you know, it's a lot of financials.
A lot of financials, a lot of basic materials, busted tech these days. A little bit of busted tech around.
Is there? Oh.
When I sort of started out in the early 2000s, it was mostly busted tech. That's the funny thing. You just buy like some shitty tech company on 3 times EBITDA, not knowing if it's going to work or not, because there's always some bad news. They've lost a big contract or something like that. They're wholly dependent on. They've got like a 50% client. So the money's the revs aren't real, the EBITDA is not real. Somehow they figured it out. 3 times goes to 5 times. That's buy cheap and pray. That's kind of my investment strategy these days.
Those were fun. I mean, I remember Hewlett Packard, I think 2012, 2011-ish maybe. And I remember after a string of just terrible acquisitions, I remember buying that stock for like 20% free cash flow yield, and they got better management. And yeah, I mean, there was a lot there. And that's when the enterprise part of the business was still connected to it. And I know we've talked about Microsoft when it was trading at 12 times earnings, a little.
It was over 10% free cash flow, right? It was like 11 something percent cash, 11.5% might have been. I saw it at 11.5 anyway. Didn't buy it. Not that smart.
Well, it was game over at that point, right?
Let me give some. Yeah, that's right. Well, you had Barmer in charge, and it had a year of revenues going down, so it didn't look that hot. It's San Diego, Comox Valley, Toronto, Brandon, Mississippi, Kerava, Finland. All right, what's up? Las Vegas, York in the UK, Gothenburg, Wiesbaden. Hope I said that. Bristol, England, Squatters Crag in Australia. What's up? Qatar, Amman, Jordan. That's straight down the list. That's a good spread. Well, what's there's? I feel like we've got plenty of content for these. Every time we log off, something happens. We spent all last episode talking to the Big Short boys about what catalyst was going to take down this, what would be the Lehman moment, and it turns out Silicon Valley Bank. That looked like it, but maybe not. Big rally today. What do you guys understand what happened with Silicon Valley Bank? What is Jake's going to tell us what a bank is, and then Tim's going to tell us what happened with Silicon Valley Bank. What's a bank?
Well, in the most basic version of it, it's an institution that takes money in, usually on shorter term basis, lends it on a longer term basis, and collects the net interest margin difference between those two, and calls that earnings, and then grows from there.
Why are you not allowed to call it? Why is it not earnings?
No, it's earnings. I'm being a little glib.
The regional banks make a lot more of their money. The little regional banks make a lot more of their money from loans than the big banks do. They're much more dependent on loans. The big banks have lots of other lines of service. They make money lots of different ways. Little banks make their money mostly on loans. Yeah.
Yeah, that's true. A lot of people underestimate the diversification of the larger banks, and I mean, you see them do pretty well in just about any environment when volatility is spiking. I mean, I'm sure that the big investment banks are printing money with the volatility we've seen over the last week, and then obviously you're right. The regionals are more net interest income oriented, but. Yeah, I mean, I'd be happy to start on the Silicon Valley Bank. I mean, really a classic 1980s style bank run, kind of with a modern twist. if you look at their deposit base, the growth was extraordinary. I think it was like 81% last year. I could be wrong on that, and it was up a lot the year before too. And the depositors were predominantly venture capital funds, VC companies, and a lot of those are burning cash, and so they're needing access to funds for payroll and whatnot. And the management of Silicon Valley Bank, instead of kind of understanding the sensitivity there, it seems like they invested in longer duration securities to benefit, and they did it. The timing was bad. They got so many deposits when interest rates were so low that they took way too much risk on that and didn't hedge appropriately. And then
let me just before you move on there, because
sure.
this is worth diving into, because it looks, what they've done is they've stuck most of it into treasuries, right?
Treasuries and
mortgage-backed securities
and MBS.
Okay.
Yeah.
What's hurt them though? Is it the treasuries or the MBS that's hurt them, or both potentially?
Both,
I guess.
Both. I mean, both would trade at a, if you're doing a mortgage at 2.5% on a 30-year per se, that mortgage would be trading at a pretty big discount right now. So both of those hurt them, and we've seen that in most of the insurance companies and the banks. You've seen book values decline unless there's something aberrational where they're able to kind of buy back stock at a discount or something like that. So that part of it's normal. But what really got Silicon Valley Bank was what seems like almost a coordinated bank run. You have depositors, in this case, pretty large VC funds and companies, and they're able to communicate and say, hey, we're pulling our money out, maybe you should too. And with technology nowadays, and that can affect any bank, of course, but especially Silicon Valley Bank, it seems almost like it was a coordinated bank run. And
to what end? To like make a short payoff, or
that's a good question, and realistically, that's a question that should be being asked. And so, I mean, I'd be curious who's buying credit default swaps on that bank and other banks, or buying puts or shorting the stocks, because that it seems a lot like a coordinated bank run. I don't know what would have prompted that so fast. I mean, I have no interest in Silicon Valley Bank. I've never used them. I've never owned the stock, neither with the other ones, the Signature or the Silvergate. Yeah, but bank runs, just like Jake was saying, I mean, anyone would be susceptible to a bank run. And I think that people need to kind of focus on what prompted that in the first place.
I think we've talked before about this, the idea of what are called normal accidents. Charles Perrow wrote a whole book about it. And we talked about it in the context of a nuclear power plant. And what ends up in these systems, the more complexity and the more tightly coupled a system is, the more at risk it is from small things cascading and turning into complete, disaster. And so you think about Silicon Valley Bank's deposit base, that's a very tightly coupled system. It's like everybody knows each other. It could get through a network very quickly that they want to pull their money, and you're just in a much more fragile situation at that point, which makes their long lending even more idiotic, to not recognize that, boy, like we could get called to the mat here if everyone who runs in the same circles decides to change their mind about who they bank with. And I think on top of that, you also had the fact that most banks have a lot less uninsured deposit base because they're, it's regular people that are under $250,000 covered by the FDIC. This was a weird bank in that it had a very large uninsured deposit base as a lot of their base. So they were even more, blowing in the wind there. So this is kind of a perfect storm of banking things that could happen. But, wouldn't be surprised if the solvency issue this was a liquidity issue for them because they couldn't tap resources fast enough on the asset side to meet the liquidation side of the deposit base. That same solvency issue, though, that they had from bonds not being worth what they were 2 years ago I think it still exists in a lot of other places. And I'm not entirely sure that we're completely out of the woods on this. The FDIC, or basically like covering everything above 250 now, helps with the liquidity issue, but the solvency issue still is floating around there. So I'm not sure we're like all done and hunky dory now.
Let me ask, what else could they have done? But like, from their perspective, I guess they would say we were taking our deposit money and we're putting it into the safest asset base that's out there. I heard Meb Faber interviewed on Fox Business on Sunday night, and he said something
Good
like,
job, Meb.
I retweeted it. It's on my Twitter stream. He said, they said, what happened with Silicon Valley Bank? And he said, they put all of their money into assets. I liked his explanation because it's so simple. They put all of their money into assets that wouldn't do very well if interest rates went up, and interest rates went up, and that collapsed the asset side of their bank. But I think that's a fair description of what happened. I don't know. Have no great expertise in this, but I had a look at. That looked to me like they were putting in treasuries, and I just thought, what else? Like there was this period in time when it didn't look like interest rates had been crushed for a long time, and I think you and I might have said, JT, that the long run interest rates are around 6%, but it's hard to imagine how we get back there in any sort of short period of time. So wasn't it sensible, logical to just be sticking them into those treasuries? Like what else could they have possibly done?
Well, you got to also remember
duration.
though, shorter duration for sure, but you got to also understand that they have liquidity requirements, and they're encouraged to own heavy proportions of treasuries to meet those. The big banks, the Citigroups, the JP Morgans, the Bank of Americas, their capital ratios are reflective of the change in the AOCI on their held for investment portfolio. So those ones,
what's the
which stands
AOCI?
for accumulated other comprehensive income.
Correct. Yeah. Yep. And so you see the changes in book value, and then you see the changes in how it kind of impacts the capital ratios. Smaller banks are not as susceptible to that. They're not under the same guidelines. I think they changed the number to maybe 250. I forget what it is. It's still a massive number, but they increased the number that it originally was going to be that you could escape, because it's pretty onerous. But the thing is the held for investment notation is I think actually pretty reasonable, because for a bank to take duration risk, whether it's on a loan or it's on a security portfolio, you don't want them marking everything to market. If it's an investment bank, that could be different. But in a situation where the job of the bank is to facilitate capital, you want them to be able to hold some of those securities for a longer time. Still, you want to hedge your interest rate risk and that sort of thing, and that's what the good banks do. But these are not 2008 MBS securities that they're holding. They're government bonds that ultimately the credit risk is not there. There is interest rate risk, so they trade at a discount now, but ultimately they will accrue to par. And don't forget that a lot of these banks were sitting on massive, many billions of dollars of AOCI gains prior to the interest rate increases. And so, it goes the same way. You don't want to give too much credit when things are more favorable, and you don't want to give too much blame when things are negative, especially when the government the regulators have wanted them to hold these types of liquid assets. I'm not excusing what Silicon Valley Bank did. They took ridiculous duration risk without hedging it, and especially they have a very idiosyncratic deposit base. And I do think you need to look at how that bank run occurred, because you don't want that. That's not healthy for anything going on in this country or this economy.
Do you think that means that the problems are idiosyncratic to Silicon Valley Bank? Or do you think that it's potentially more systematic? Okay.
I think it is. I mean, if you look at the ones that got hit, it was Silver Lake. I believe it was Silver Lake. I think it was called. It was Silicon, and it was the Signature. And so two of those had crypto exposure. The other one was a lot of VC funds. I mean, the thing is, you don't want to change the regulatory rules or the capital ratios in the middle of the game. They already did the smart thing. I mean, as they basically doubled the capital requirements and the liquidity ratios after the global financial crisis. So banks are a lot safer than they had ever been. And so, you know, these banks can meet their requirements, but if you're saying, oh, well, you know, you lost money because of higher interest rates and somehow, you know, just because you meet the actual capital requirements that the laws dictate, you know, because you've lost money on your held for investment portfolio, somehow you're not solvent or whatever, because if all your depositors leave you, you're not viable. You know, we need to not have bank runs. And so I don't know what that means for the FDIC. I think it's tough for them right now to do anything but guarantee those deposits. And I'm not pro that, especially not in the Silicon Valley case. But I think that now you've crossed that bridge, and it's tough to, you know, differentiate between different banks or different depositors.
So a couple of things there. One, I don't know the exact number. I'd be curious if someone else could ferret this out, but I thought I saw it at one point that there's, call it $1 trillion worth of uninsured deposits in banks right now. So which effectively the Fed has put onto their own balance sheet now. Like that's a liability, like they're underwriting another $1 trillion. You know, where if they have to come out of pocket for that somehow, where's that going to come from? Well, the asset side is going to come out of thin air. Like they print the money to give it to cover that. I mean, how is that not potentially going to be inflationary, which just keeps us raising the rates and potentially, like, we're going to be in this difficult situation, I think, for a while. The second thing, so even let's ignore like the panic and the bank runs, the psychology side of things, and let's look at if you're a bank and your deposit base, like how do you keep your deposit base? You have to offer a competitive interest rate to the clients for them to stay. And if you locked in a bunch of really low yielding long-term assets like MBSs and treasuries, and someone else lent short term, and now they're rolling back over with a 5%, let's say, return on their asset side, they can offer a much more competitive rate now for to depositors. So Interactive Brokers, let's take as an example, versus maybe Schwab, who might be on the longer side of things. Interactive Brokers kept theirs low and now can offer, and will absolutely go out of their way to advertise how much more they can offer for cash balances relative to their competitors. And so how eventually just the economics of like being offered 5 instead of 2 because of the nature of the way the banks structured themselves, I think erodes that potential base, and how quickly that happens can look like a bank run. And it doesn't have to be a panic. It can start slow and then build up from there, and then it turns into the psychology part of it kicks in, and now people are fleeing. I mean,
it's a very at some point.
Yeah, it is. It can be a phase shift. I think it's a fragile situation right now. I mean,
have we seen is that what Silicon Valley Bank is? Is that the first of the phase shift that we're seeing?
They were probably the most exposed to, you know, being super long duration and high interest rate sensitivity, along with a very like aggregated risk pool of depositors. So if it kind of makes sense why it might be the kind of canary in the coal mine, but it could happen at other banks on a slower, maybe like more played out basis. And it wouldn't surprise me.
Well, where you see that is, I mean, banks can manage for that. So, you know, going into, like, let's say last year, a lot of them had excess deposits because there was so much cash on hand and interest rates were low. And so they had too many deposits. And so, you know, they've actually been surprised at how well they've been able to benefit from higher interest rates without paying more on the deposit side of things. You know, different banks, you know, have various advantages, and so a company like a Bank of America or Wells Fargo, you know, they offer services beyond maybe just, you know, interest rate. And so you might have, like we were talking about earlier before the show, just you might have your payroll or your, you know, estimated taxes in the accounts at those types of banks, and you're not nearly as rate sensitive. So I think where you'd see it is not some like climactic massive thing. I think you see okay, deposit rates are going to go up a little bit. Net interest income or net interest margin gets squeezed a little bit. There's plenty of room for that to happen. That is what's expected to occur. The idea that I mean, don't forget, they offer CDs. They offer, a lot of the banks now, almost all of them have some types of investment accounts associated with it. So, I mean, you could keep it in house, where they're still benefiting from it. Where it takes on a different phenomenon is when it's a bank run, so yes, net interest margins should be squeezed. That's better for everybody. The banks have gotten away with paying too low. I totally agree with that. But a huge difference is, I mean, like people are trying to say like Schwab, has an issue there. Well, they have huge liquidity resources that they can use. They have plenty of capital, plenty of access to capital. And the thing that we haven't mentioned, guys, is that if you just take out bank runs and leave all the other factors in play, including credit, including commercial real estate, everything, they're still making a ton of money. Like this is not a 2008, it's not even a 2011. Profitability is so much higher going into this. The reserves, because of CECL accounting, are so much higher, reflective of a recessionary environment that hasn't materialized yet. So I think we need to separate, the bank run aspect of it with a solvency aspect. I think that's important, and I haven't seen enough of that. I think it's been a lot of kind of panic the last few days, understandably.
Do banks do better in a rising rate environment or a falling rate environment?
Depends. It depends on credit. I mean, so they're making way more money on net interest income over the last year and a half. I mean, it's huge for Bank of America, for Citigroup, for all of them, pretty much. But then you also have the changes in reserve. So credit was outperforming for years. 2019 was a great year for credit, and then with the pandemic and the lockdowns, they built up huge reserves, but the credit losses didn't really materialize due to the stimulus. And so now you're seeing normalization. They're already more heavily reserved because they need to reserve now for the life of the loans. Another thing that doesn't get talked about enough is CECL accounting is a huge change from how it was before. So it depends. So they're going to build reserves, especially for stuff like commercial real estate, credit cards. They already have pretty big reserves. That'll keep creeping up a little bit. They'll make up for that on interest rates, and there's plenty of room for reduced net interest margins, and that should be the consequence. There shouldn't be bank runs.
Do you feel like probably the catalyst for, if there's going to be a catalyst for any sort of, volatility in the stock market, it's unlikely to come from something like Silicon Valley Bank, unlikely to come from something like the regional bank. It's going to come from somewhere else.
I mean, it always seems to filter, to banks at some point. I mean, especially right now, I think you get 3 weeks from now, we'll see earnings. 3 or 4 weeks from now, we'll see earnings for the banks, and they'll probably be pretty good. They'll probably be pretty good, and I'd estimate that most of those metrics will be pretty healthy. So I think, the businesses are doing well, but there was a different panic phenomenon. I think that, not saying that there aren't fundamental issues with duration, and that's obviously Silicon Valley Bank made idiotic mistakes in regards to duration and their deposit portfolio. But I think all of that is very manageable. But I think what you're seeing is a bear raid, and it almost looked like somewhat coordinated bank run on Silicon Valley Bank, and then the Signature thing, I saw like 20% of their deposits. It was just fear running the day on Thursday and Friday and Monday too.
Well, was it whatever it was, Silver Lake or Silvergate, whatever that, like the crypto type bank? Was that the thing that kind of that something happened there that kind of stumbled, and then all of the VCs have chatted to each other and said, "Oh, Silicon Valley Bank's also." I mean, it's possible it's not coordinated in the sense that they were trying to achieve something. They were just like, "Hey, we're all pulling our money out. We're going to stick it somewhere else. I don't know where we're going to put it. Crypto solves this."
Exactly. No, it totally is, and I think it scared the market on Sunday night. The policy where they're taking treasury bonds or mortgage-backed securities and exchanging liquidity, that's very favorable for the banks. I agree with Jake. I think it is inflationary, to do something like that, and so there's negative consequences to it as well. But then when Signature Bank kind of got taken under, it's like, okay, well, who's the next one? Who's the next one? And so the next one in line has actually been a pretty well-run bank from my understanding of it, First Republic. And so I think there just has to be a delineation is okay, well, what is it? Is it a stock price declining that is going to do this, or is it a certain amount of deposits going out, or what? I just think you have to have a clear regulatory framework which should exist. And so I think if the dominoes stop there, I think this could be a very short-lived crisis, and you just get back to the economy. Okay, how do offices do? How do people hold up in credit? That sort of thing.
It's hard to imagine that any regional bank is going to be very bullish with their loan book right now, right? Like they've got to be pulling back the horns big time, which should be somewhat contractionary, right? For kind of from an economic standpoint.
Definitely.
I mean, Silicon Valley Bank looks like it's out there being pretty aggressive. They got they're fully backstopped and they want the deposits back. I mean, that's the deposit side. I don't know how much they're lending on the other side. I don't know if I would want to be lending too much.
Well, who's going to lending for, home construction, or, like just your neighborhood bank that's going to loan to, build a strip mall or something? Like I would imagine that there's a fair amount of risk appetite that's been sucked in with this.
100%. Like I've seen evidence of that. Especially Orange County is a big real estate mecca, like a lot of the other Sunbelt areas, and I think there's evidence of that, and people are trying to resort to things like hard money lending and that sort of stuff, and that capital is very expensive. So you're exactly right, and that's deflationary in itself. And the other thing that should get mentioned is just when you saw treasuries rise in value and rates drop like they did, so
Crazy,
severely the last few days, that has an offsetting impact on the AOCI number, right? So
yeah.
So it turns that number pretty dramatically. Obviously some of that's been reversed today with the hot core CPI data, but that's the
like
benefit
bouncing off the guardrails here in Florida.
Oh man, it's crazy.
Jesus.
I had a look at the 10.3 inversion today. So the data goes back to January 1982. So it's not comprehensive. The little whatever that the Edgar SEC website, whatever it is. The widest it's ever been was 1.32, or the steepest it's ever been 1.32, and that was in January 2023. And today it's 1.32 again. So it's the second reading. It's the steepest it's ever been since 1982. I tweeted that out earlier.
Bullish?
I don't know if any of that means anything. I have no idea what all that means. Like I've read Cam Harvey's disavowed his own research in relation to this thing. Every other one has had a pretty nasty recession that's followed. Everybody's saying it's not going to happen this time. I'm just kind of, at this point, I feel like I'm just a scientist. I'm just interested in seeing what happens. So I don't have a view one way or the other.
I feel more like I'm watching a play. I just want to see like what happens in the third act here.
That's kind of how I feel.
I mean, I still think we did see a technical recession last year. Whether you want to call it one or not, we can define things however we want. But there was a technical recession last year, and I do
wasn't a recession, wasn't a bailout.
Especially if you use real terms.
Said so.
I mean, prices moving up 8%, but unit volumes of everything are down. So I'm not sure how you consider that not a recession.
I actually have some sympathy for the view, not a technical recession. I understand why they said that, but the definition is the definition. But I still think that there's, every other indicator is there. I don't understand why everybody's so eager to suggest that it's not a recession. There's not one coming.
I think there's a recession coming. I think there's a recession. I don't think it has to be. I mean, our recent memory of a recession is 2008, which it's just like when people tell stories of their grandparents or whatever saving the tinfoil, stemming from the Great Depression. The Great Recession was traumatic, depending on your industry or if you were in the markets, we all remember it was unbelievable. So
Well,
I mean, it could be normal.
That's why financials have been so cheap for so long, because everybody thinks that the next one looks like the last one.
True. If you look at like, you take like Citigroup's tangible book value per share. I mean, obviously since after they had to raise all the capital and stuff like that. But what you see actual growth in some of those tangible metrics. But you see the valuation just keep, staying really cheap. So you're absolutely right. I mean, remember the banks, I mean, Citigroup probably in 2000, it probably traded at 5-7 times book value or something. AIG too, a lot of them did. And that's the thing, return on equities are a bit lower now. There's the banking system is a lot dramatically safer than it was before, which is why I think this is kind of a concocted crisis. And it's like sure, if you assume that there's a bank run on like these massive enterprises that have all these earnings history and 50-year histories, and they have to somehow sell all their assets, which they're allowed legally to say held for investment. Yeah, that's going to be a problem for anybody, but I don't see why, you'd get those bank runs. I would be curious to know, like, who bought credit default swaps prior to, that bank run occurring. Be interesting.
Somewhere Michael Burry smiles in the dark.
What was that tweet? Did you guys see his tweet yesterday?
Yeah.
I don't know if it was sarcasm or what. You never know. He's an interesting guy, but
I think
one thing I haven't heard anyone ask is, so if one of the core issues was that rates moved up quickly from relatively low, what's happening in Europe or Japan where a lot of the similar dynamics might be playing out of rates moving up quite a bit from, in that case, like negative, just moving from negative to positive. There's a lot of convexity down at that zero bound as far as bond pricing goes. I wouldn't be surprised if there's some shoes to drop there too eventually.
Yeah, I think they have to hold a lot of liquidity. I mean, just like U.S. banks, they have to hold a ton of liquidity. So that's part of it. The other thing is the European banks, they had to, and Japan, I don't follow Japan as closely, but they had to figure out ways to make money when there was basically negative interest rates. You know what I mean?
What do they do? Have a raffle?
Yeah.
Do a sausage sizzle at the front of the bank.
Whether it's fleet financing, insurance, there's lots of different ways, diversification between different regions and stuff like that. So I mean, when you see 80% deposit growth and then they just pile it into a bunch of longer duration MBS and treasuries at 1.5%, and the deposit base is what it is. And I've heard that, I mean, I don't know for sure, I've heard it like, hey, well, we want stock in your company and we'll extend loans or stock options, that sort of thing. So it's, those people abandoned them and there was a run. And I mean, I just think that the idea of extrapolating that to all these other banks, is a big mistake.
JT, do you want to we didn't do your veggies last week. Do you want to?
Oh yeah.
So it's a segue and then.
It's not much of a segue, but yeah.
It's the best I could do.
Yeah. So yeah, this is inspired by, I read this book called Ice Age, The Theory That Came in from the Cold by John Gribbin. And John Gribbin, I've done other books of his before, and he's like a really interesting author. I like him a lot. And this actually came from Munger, recommended this in the early 2000s at one of the annual meetings. And this book is about, mostly about this guy named Milankovitch, I guess, maybe. I'm not sure how it's said. But he was a Serbian scientist born in 1879, and he grew up in war-torn Serbia, and which at that time was stuck between like two decaying empires. You had the Austro-Hungarian and the Turkish Ottoman Empire, and they were like fighting, and they would like trade Serbia back and forth, and basically in the fighting, which is kind of an awful situation in a lot of ways. But he was trained as a civil engineer, and he's actually well-recognized expert in designing very large concrete structures at that time. Like, foreign governments would contract him to like come and, be a consultant on these like giant, infrastructure projects. But he had this side hobby that was nearly all consuming for him. And what he wanted to understand was, how did the sun drive long-term climate? And actually not just for Earth, but for other planets in the solar system as well. And it took him like literally 30 years of these hand calculations, because back then there wasn't a computer to crunch all this stuff. He's with a paper and a pen, literally like working the math out for the sun and like hitting the Earth at different points, and like how much energy is transferred from the sun to the Earth, and how does that impact climate? And part of the reason that it took 30 years for him to do it is because like he had to go off to war a few times. And, you know, like during World War I, he was captured and imprisoned. And luckily he had all his, like what he called his cosmic papers with him. And so he like was sitting in a cell, like working interrupted on all of this math. So it's kind of a, you think about, you know, scientists today conducting research, you don't think about them doing it from a prison cell.
With a pen and pencil and paper.
Yeah, with a pencil and paper. So anyway, Milankovitch, he created this comprehensive mathematical model that calculates the differences in solar radiation at various Earth latitudes, and along with the corresponding surface temperatures. And the model is sort of like a climate time machine in a lot of ways. Like you can look forward and backward using it. And so he hypothesized that long-term collective effects of changes in Earth's position relative to where the sun is a strong driver of Earth's long-term climate. And so basically, like, and those changes were responsible for triggering, you know, glacial periods, aka ice ages. And so he looked at the Earth's orbital movements, and there are really like three things that go towards that. And I'll try to move through these quickly since it's kind of, you know, esoteric science stuff. But the first is the shape of Earth's orbit, which is not perfectly, you know, circular. It's called eccentricity. And so that is due actually to the gravitational pull of Jupiter and Saturn. Even though the sun is like makes up a huge part of the mass of our solar system, Jupiter and Saturn are such that they're big enough that they actually impact the circle that Earth makes around the sun. So anyway, so currently Earth's eccentricity is near its least elliptical. It's like it's most circular, and therefore, and it's actually slowly decreasing in the cycle. And that takes about 100,000 years just based on where Jupiter and Saturn are. The next thing that impacts it is the angle of Earth's axis tilted with respect to like its orbital plane, which is called obliquity. And so that is actually the reason that we have seasons. So the greater the axial tilt, the more extreme the season due to being tilted toward or away from the sun. And so Earth's axis today is currently at 23 degrees, which is about halfway in between the two extremes that it moves around in. And that happens on about 41,000 year cycles. Like how much does it tilt? And then the third thing is the direction of Earth's axis of rotation. It's pointed. And so that's called precision, Precission. And that is, as the Earth rotates, it kind of wobbles a little bit around its axis. And this is actually due to tidal forces caused by the gravitational influence of the sun and the moon. So the Earth kind of bulges at the equator because of this gravitational pull, and so there's like a little bit of a wobble to it, and so that actually changes somewhat the effects of the sun hitting the Earth, and that has about a 25,000 year cycle. So you have this like 100,000, 40,000, 400,000, and then like 25,000, and all of those are moving on different kind of cycles, and so they line up, and then they like move away from each other over different time periods, and you sketch all that math out. And you end up with, you know, these climates that happen over periods of time, and they're actually kind of measurable. And so what ended up happening was that he had this theory, and he actually died in 1958. And his model at that point was like largely discredited because there was no way to really prove it. But they started doing these drillings into the sediment in the ocean, like deep sea, where it's actually like very little amount of silt is laid down, but it's a very consistent amount. And so they can then date it, and using carbon dating, like they could figure out like how deep is the sediment, like what does it look like? And then there are indicators within there that of actually like microbial like DNA that they capture from like what died at that time and then fell down to land on the bottom. And they can tell like what was the temperature actually based on like putting all these pieces of the puzzle together. and it turns out that like he was pretty right about all this stuff. And so like NASA's website says that this Milankovitch cycle only explains about 25% of our current like climate, and like the other part, like they're leaving open for more of like man-made stuff that, you know, is, and I don't want to get into like a bunch of political, you know, which is what climate has kind of turned into, but so let's like zoom out and get to our tortured analogy of all this. You know,
this is the best part when you got to bring it back.
Yeah. Oh, let's try to land it. Shit. So it was a very counterintuitive finding for Milankovitch's work, because it's not the colder winters that actually lead to ice ages, which you might think. It's actually the buildup of these huge glaciers that overtook most of Northern Europe and Canada and the Northern US roughly 20,000 years ago. They came from actually like mild summers. So the summer didn't get hot enough to melt the ice off, and then the winter just kept laying more and more of it down. And so it's actually mild summers that were that call it the problem of creating an ice age. And similarly, you know, I think when we have cheap debt for a very long time, accommodative monetary policy and fiscal policy, bailouts, which by the way, I wrote all this piece like before anything was happening, you know, in the last week. And we shield the economy from bankruptcies, which if you look at the bankruptcy numbers over the last 10 years, like it's been record low bankruptcies happening, which happens when you have cheap money. Like you can always just sort of borrow and extend and keep the game going, right? But what I think you end up with is very mild financial summers, and therefore you don't get the burning off of the ice, and it builds up, and then when it actually does get cold, like you end up with a potentially like a financial ice age where, you know, it becomes a much more devastating consequence, because actually the life at that, you know, is not adapted to that level of ice and coldness. So, you know, you're sort of setting yourself up for bigger problems by not actually having a little bit warmer summers that burn off the ice in a financial sense. So I don't know if I landed that one or not, but
I like the analogy. Let me ask you though, isn't Japan is like, I don't know how far ahead of the US, and I perceive Japan as being a little bit further ahead of the US in terms of they've got much more debt, much more government debt relative to the size of their population. They have historically had a very, it's one of the biggest economies in the world, lots of innovation, also one of the older populations in the world, and a huge amount of government debt. So I think in some sense I don't know if the US is necessarily going in that direction, but that's like the sentinel or the position that you could get in if you don't reverse before you get to that point. And it doesn't seem to me like nothing really bad has happened so far for Japan. Like so far is doing a lot of work in that sentence, but do you think that's fair? Like it feels like there should be some tipping point at some point, but evidently Japan hasn't got there yet, and they're a generation ahead. Tell me what's wrong with that analogy. What's wrong? How's that flawed?
Well, I think, I mean, I don't think that there are the exact same correlations between the US and Japan, in that I think the vibrancy of the US economy is quite a bit different. I think you have a very homogenous population with no immigration in Japan,
right?
Which I think actually allows you to like suffer more in certain ways. Like you just won't make changes because, you know, everyone sort of is in it together. You know, it's like very family oriented, kind of collectivist in a lot of ways that the US isn't. So, you know, we have a lot more immigration. We have, I think, a more vibrant economy that changes more and that is willing to adapt to whatever the conditions are. Whereas I don't get the sense that Japan has been it's more of an ossified system that is, you know, kind of a little more static, and therefore it sort of just like decays more. I'm not sure the US fits that mold necessarily. I do agree though, like, you know, debt to GDP numbers, there's a lot of things like zombification, all of that does seem to have some parallels. But I don't know. I think I would be hopeful that we are vibrant enough to maybe avoid that path, because like growth is what solves all of these problems, right? Like, how do you get rid of debt problems? You grow out of them.
Inflate it away, print money.
Well, that's one way. But ideally, the better way is
that's the way we're doing it, isn't it?
GDP per capita is the important number here, and so, you know, that if you can grow the GDP per capita in such a way that shrinks the obligations of the liability side as such, that's ideal. I mean, that's kind of what we did in after World War II, when we had a very large debt base that we financed the war. We then grew out of that debt issue over the next 30 years. But
Japan's had that. They don't allow companies to go bankrupt. They allow a lot of cross holdings,
right,
so that they have those zombie companies that basically the business has shrunk so much they just can't service their debt anymore, but they just let them keep on lumbering on because they employ so many
jobs.
people.
Yeah.
Are we sort of starting to do that?
I mean, in our probably the most uncharitable version of, we'll see. I mean, a lot of it depends on how do we respond to the next time that there's stress. Do we allow the system to cleanse, or do we just keep like papering over the bullet wound?
We've shown what we're going to do, haven't we? We all know that you can write. We know exactly what's going to happen. The argument this whole way through has been the Fed will hike interest rates until something breaks. So people are like, well, Silicon Valley Bank
broke.
Yeah.
So therefore they should stop. But at the same time, now we've got red hot inflation readings. They're going to have to keep on raising rates to deal with that. When they cut, the market will fall over at some point and they'll cut. I mean, the market is down on the year, down on the 6 month, down on the 1 month, down on the 5 day, up a little bit today, up a lot today, to be fair. I kind of feel like we are seeing this slow motion crash. We just haven't seen the final, we haven't seen the face of the market yet. The market shows you its face we saw it in March 2020 at the bottom, when it's just full on panic. When I open Twitter and get a contact high from the fear. That's when you know that we're there.
Is this why you made Wile E. Coyote for when you posted in Twitter?
Go back and look at them. I've been doing a few. They'll crash test dummies, I think, last week.
Because he's not looking down, therefore he won't fall as long as he doesn't look down.
Yeah, that's my point. What do you think, Tim?
I mean, I think last year, if you look at it, I mean, bonds have never had a year like that since they've been tracking the performance. So, I mean, there was a lot of carnage, and that's what's kind of interesting now is that the real damage was last year in relative to interest rates. So a lot of those kind of losses, are of what we saw last year. They don't necessarily always have to realize it. But yeah, I mean, you could be right. I mean, I think that there's, fertile ground for, more of a sell-off. I also think that, there's some decent signs, like the consumer is still relatively strong. It can be pretty hard to find, employees. That unemployment is pretty low. If inflation does slow down a bit and the Fed stops raising rates, obviously that would help a lot of industries. I don't know how realistic that is in the short term, that they could actually cut or anything like that. So, I mean, I think if there's a recession, I think it could be a manageable one as long as it's, based on root fundamentals. I think what I don't like about just kind of the current crisis is that I feel like it's somewhat manufactured, and that it's not something that necessarily needs to occur. But if you yell fire in a crowded movie theater, you're going to create a problematic situation. So that's, I think, something that should be watched out for.
Yeah, I think it's probably more of an accident than coordination. I think it's, but I don't know. But
I like Hanlon's razor on this one.
What's that?
Never attribute to malice that which can be explained by stupidity.
Yeah, it could be a combination of both. I mean, it could be a combination of both. I mean, the bank made its share of problems, clearly. Like I have no compassion for what the management strategy of that bank was by any means, but to get an actual run on the bank, it's interesting how that came about, and just the fact that it's VC companies and all their portfolio. That's not normal. That's not like how the deposits are at your local regional bank. So it's an interesting dynamic, and yeah, the one thing
oh, sorry,
go ahead.
I was going to ask a question. Do you think so? the amount of money that was pulled out of Silicon Valley Bank is kind of staggering, like how fast it happened. Do you think that today's tools, and let's say the Fed as one of them, as a big tool, pun intended.
I agree with that
has
characterization.
Is that well suited for today's world where things can happen just incredibly fast? Like I'm worried that they're just going to be kind of always fighting the last, data point that came in, and like the world is just moving so quickly that they're like,
isn't that always the case? Isn't that always the case?
Yeah, but maybe more so than, a huge percentage of the deposits flew out of that in like 3 days. That's amazing, right?
Yeah, you have to look. I am not someone. If you look at like who was getting bailed out, equity holders got wiped out, creditors pretty much got wiped out. The depositors definitely got bailed out without a doubt. And it's an interesting breed of depositors. It's not kind of the average Joe that has 50,000 over the minimum requirements per se. So that should understandably cause some frustration. But
Tim, are taxpayers on the hook?
Only for the difference.
No, the Fed's got it.
Well, they'll raise the premiums on the banks. So the banks will end up paying for it over time. But don't forget, it's only the excess over the assets that they're able to realize that the taxpayer theoretically would be on the hook for. But that normally the banks normally pay for it via an insurance premium that gets collected over time. So I think that could be worked out. But to your point, Jake, I think realistically, you can't have an implicit guarantee on just like Silicon Valley Bank and Signature Bank and then not do the same thing, because the world is different after that. It's a huge change. It's just, we saw the same thing with the GSEs. It's just not realistic to have the status quo, as it is. And so I hope we don't have to learn that the most painful way possible.
Doesn't it feel like if the market, if bonds are down, bonds have their worst year in whatever, like history or modern history over the last year. Equities had a bad year, but like equities have had lots of worse years than that. It seems to me like equities somehow just skated completely over the speed
past
bump.
The graveyard.
Well, yeah, that's kind of how I feel. And when we've seen this in the past, the Fed will keep on raising rates until something breaks. And then really probably what I'm talking about is the market. Like individual regional banks blowing up, probably that they can rationalize that. But at some point, the market cracks. And then go back and look at what they've done every single time the market's cracked. They lower rates, but it doesn't, like the first count them, like 5 or 6 rate cuts won't do anything to the market. I don't, the John Hussman's theory about why the market rallied in March 2009 was they stopped having the banks having to market. He says that little accounting change was the biggest.
It did, but it wasn't that was because it was a stupid accounting. It was a stupid accounting policy in many ways, because what happened was it was a self-fulfilling prophecy where, the securities, the credit default swaps and the RMBS were trading at such extreme levels that basically when they had to mark to market, it showed that the banks had to keep raising capital. And then to do that, you're issuing stock at lower and lower prices. But it was all a lot of uneconomic stuff, because what happened to those RMBS securities in the following years? They were some of the best securities you could have owned. So the prices were uneconomic. And if you want your banking system to be like a day trading environment, if you want it to be basically a day trader with everything marked to market, I understand that investment banking, retail banking and investment banking are two different things. I think that there's legitimate reasons for not, if you want someone to loan 30 years on a mortgage or 10 years on a business loan to a small business, you don't necessarily want that loan marked to market, to foster capital availability, in my opinion.
Tim, speaking of changes, do you think that they will consider changing that held to maturity rule, where maybe they can release things out of held to maturity without repricing the entire portfolio?
That's a good question. That could be possible. I definitely think you're going to see, regulators and government officials focus on that. Maybe you have the same requirements that the big banks have. You know, I mean, where they have to reflect it on capital, but give them time, you know, to build up to that level, to where they're able to do that, and that does increase the costs of the banks, and ultimately that flows through to depositors and stuff like that. But yeah, I think that would be a reasonable thing to look at, and you just give them, you know, a few years to build up to that. But the immediate thing is just getting out of the immediate crisis, because there is one. I mean, you know, they guaranteed all the deposits, and right now it's implicit, and I think that, you know, you have to address that. You can't just like leave it open-ended, because then, you know, bears and you know, stock market you know, traders, they're gonna manufacture a crisis that might not necessarily exist.
There's kind of a Chesterton fence question to this that I wonder about, which is, if it's such a good idea to insure all of these deposits, why haven't we been doing this all along for hundreds of years that we've had banking, and or at least since 1913, let's say?
Probably because it's just, you know, they don't want anything that favors the wealthy, you know, is going to be, you know, spark partisanship and polarization. I mean, most people, you know, aren't impacted by having balances over, you know, the minimum. So I mean, that's what's so crazy about this. If this was just a normal regional bank that had some mishaps, and it's just a regular kind of deposit base, and I'm not saying anything bad about the deposit base, it's just, it's not a regular deposit base, and then they bailed it out, that then maybe, okay, hey, we did this for one mistake, that's not going to keep happening. I don't know how you do that for this particular one, and then, you know, not do it for the other regionals. I don't blame depositors in general. Like, I mean, I just don't think, like, your mom shouldn't need to pick if the bank is sound. That's
Yeah,
kind of
but
the regulator's
your mom's
job.
not putting 250,000 plus in the bank, right? Like, we're not protecting grandmas here.
No, I mean, I don't know. No,
Their
no,
business
they're
is-
not.
There
Yeah.
should be
Tough shit.
sophisticated enough to solve this problem, right? If you're managing that much money.
Do you deal with this problem at all? I mean, I don't store sums of money like that, so I don't know, but I don't know what I would do.
I definitely do. You don't keep that much cash in a bank.
Yeah, internet call account.
That's foolhardy.
Yeah, that's fair.
Well, yeah, and inflation. I mean, obviously, you've got to adjust those numbers because there's a lot more money sloshing around right now. So payroll and taxes and things like that are bigger. I don't know. I don't blame depositors. I don't think that's the people to blame. The FDIC, it's paid through you know, bank insurance premiums. They'll raise those levies, and you know, the banks are heavily regulated, and obviously there probably was some regulatory lapses there. So I mean, I just don't think, like, bailing out. Yes, these depositors got bailed out. I normally don't think that. I don't think that's the worst thing in the world when depositors get bailed out. I don't want the executives or the banks or the equity holders or you know, they shouldn't be bailed out in that, would be my opinion.
I mean, the
tend to
FDIC
agree
could
with
just
that.
guarantee them all, right? There's a cost to guaranteeing them. It's insurance on those deposits. You just charge that fee. You make it mandatory.
Right, and there'd be
problem.
less problems if they did it now, because they might have to do it now. I mean, because if you get a few more bank runs, you know, when people realize that there's money to be made through doing it, not saying that was planned, I'm saying that was something that easily could happen, then the cost will actually be higher. You know, so it's like, you got to realize right now there's a problem where, you know, there's this implicit, you know, guarantee, and so the ultimate cost will probably be a lot lower. Even TARP, for as much as people hated TARP, the actual losses were pretty negligible relative to the, you know, level of crisis. The problem there was that executives and people like that did not go to jail, but for the most part, you know, equity holders were wiped out or virtually wiped out. So, I mean, it's I think defining bailouts kind of like defining risk. You've got to define who's getting bailed out and why. I mean, I don't think equity holders of Silicon Valley Bank feel like they got a bailout. Rightfully so.
And on that note, thanks, gents. Thanks,
Guys.
Tim.
Thanks,
If
Tim.
folks want to get in contact with you, Tim, how do they go about doing that? Have a shout out.
My website's ttvalueinvesting.com. So feel free to reach out to me on there, and also my Twitter handle, which I think is Tim Travis Value, but I don't even know for sure. Not
I'll
the
link it up
biggest
in the show